Everyone keeps talking about bull runs, halving cycles, and the next big rally. But behind all that excitement, there's a problem that most people completely miss. It's not about Bitcoin, not about interest rates, and not even about inflation. It's about something much deeper. The one thing that decides whether the entire financial system keeps moving or breaks down. That thing is liquidity. Now, liquidity isn't just a finance word. It's the bloodstream of the global economy. It's the oxygen that keeps every market alive, from stocks and bonds to crypto, housing, and trade. And when liquidity starts disappearing, everything else begins to suffocate. The International Monetary Fund, the IMF, has been quietly warning about this for months. In their latest Global Financial Stability Report, they didn't use dramatic language. They never do. But hidden inside all the technical words, they said something very serious. They wrote, "Global funding conditions remain fragile, and liquidity risks are rising." Now, if you're not used to reading IMF reports, that sentence might sound boring. But in financial language, that's code for something's breaking. Let's translate that. Funding conditions remain fragile means that banks and large institutions are struggling to find cheap money. Liquidity risks are rising means that if something shocks the market, a default, a currency crash, a bank failure, there might not be enough cash in the system to absorb the hit. That's what happens before every major crisis. If you look back at history, every big collapse, 2008, 2020, even the crypto crash in 2022, wasn't just about bad debt or bad management. It was about liquidity vanishing faster than anyone expected. When investors panic, everyone rushes to get cash at the same time. But there's never enough of it. That's why the IMF watches liquidity like a heart monitor. When they start using words like fragile and stress, it means the pulse of the global system is getting weaker. So what's really going on? Over the last few years, central banks printed a historic amount of money to fight crises. That liquidity flooded every corner of the market: bonds, real estate, crypto, you name it. But now interest rates are high, and central banks are pulling that liquidity back. They're trying to shrink their balance sheets and look responsible. The problem is, the world got addicted to easy money. Every part of the system, governments, companies, households, started operating as if cheap liquidity would last forever. Now that it's gone, the system feels like it's drying out. And when that happens, cracks begin to show. We see small banks collapsing. We see currencies in emerging markets losing value overnight. We see bond markets freezing for hours because no one wants to take risk. That's what the IMF means by rising liquidity risk. They're not warning about a crash. They're warning about fragility. A system that works only when liquidity is abundant is not stable. It's a balloon. It looks big, but it's full of air. Now, here's where it gets more interesting. The IMF isn't just worried about markets. They're worried about something bigger: the architecture of liquidity itself. For decades, global liquidity flowed through one main channel: the US dollar and the SWIFT network. That was the highway for global money. If the dollar sneezed, everyone caught a cold. But today, that system is changing. New regional payment networks, CBDCs, and instant settlement systems are emerging everywhere. The BIS is building Project Nexus. China has CIPS. India has UPI. Europe is linking tips to regional platforms. In short, liquidity is becoming fragmented. Instead of one big global pool, we're starting to see smaller, regional pools forming, each controlled by different networks and currencies. From a technical perspective, this is fascinating. But from the IMF's perspective, it's terrifying, because it means they can't control liquidity the way they used to. In the old model, when a crisis hit, the IMF and central banks could inject liquidity into the dollar system and calm the storm. Now, if stress appears in one regional network, for example, a CBDC system in Asia, that liquidity might not flow where it's needed fast enough. The pipes are no longer fully connected. That's why the IMF keeps using the phrase market fragmentation. It's their polite way of saying the world's money is slipping out of our hands. They're trying to adapt. That's why you see more coordination between the IMF, BIS, and World Bank lately. They're designing what they call a new liquidity safety net. Basically, digital mechanisms that can redirect liquidity between countries instantly. It's the digital version of what swap lines used to do between central banks. But there's a catch. If liquidity becomes programmable, that also means it becomes controllable. And whoever controls the rails controls the flow. So yes, these institutions are trying to make the system safer, but they're also making it more centralized in terms of data and more automated in how decisions are made. Let's be honest. The IMF isn't just a financial doctor. It's also a political institution. When they say liquidity support, it often comes with conditions, reforms, regulations, and policy control. Now imagine that kind of control embedded directly into digital payment networks. That's the direction we're heading. A world where liquidity can move instantly, but also be restricted instantly. So when the IMF warns about liquidity, they're not only talking about technical stress, they're preparing for a new system where liquidity is both digital and programmable. The irony is, we've seen this pattern before. Every major crisis leads to more centralization of control. After 2008, we got stronger bank oversight. After 2020, we got global coordination on stimulus. After the next one, we'll probably get digital liquidity management, real-time data feeds, automated capital flows, and AI-based monitoring. The idea sounds efficient, but it also means the system becomes less free. When liquidity becomes a line of code, someone, somewhere, will decide when to turn it on or off. And that's the quiet part the IMF doesn't say out loud. So what should we expect next? Probably another round of interventions. More temporary liquidity programs, more stabilization measures, and eventually, a coordinated digital framework for global liquidity management. The IMF will call it modernization. But it's really consolidation. They're trying to make sure that when the next wave of stress hits, and it will, they can move money across borders instantly through systems they already oversee. And that's why you're hearing all these subtle phrases lately. Digital liquidity buffers, cross-border coordination, real-time settlement. All of them point in the same direction, toward a system that's faster, smarter, and more connected, but also more controlled. So the next time you see a calm, technical statement from the IMF saying, "Liquidity risks are rising, don't ignore it," behind that polite warning is a signal that the old model of global liquidity is breaking and a new one is quietly taking its place. The world isn't running out of money. It's just changing how money moves. And when the rules of movement change, so does everything else. That's what they're not telling you.